All right. I want to thank everybody for joining us. We got a lot of people online, and in the interest of time, we got a lot to cover. We're going to go ahead and get started. There will be a recording of this made available on our website. It is definitely a topic that is obviously something everyone wants to tune in for. So I wanted to let you know we're going to kind of change the format a little bit because we have had so many of our clients and advisors and even just curious investors who aren't even clients of ours sign up for this. So the normal format of the SEM University is we're in and out in 30 minutes. And we're going to stick to that somewhat in that the prepared presentation will be done by 12:30 Eastern time. If you do have to hop off, again, a recording is going to be made available at semwealth.com/webinars as soon as it's there. We're then going to spend the next 30 or however many minutes it takes to answer all the questions. We've already had 11 questions sent in with the registrations, which is about 7 or 8 more than we normally get. If you do have questions as we go throughout there will be a Q&A button on your screen that you could pop that in there, and we'll add those questions to the queue. So with that, I want to get started, and I want to set the groundwork to understand that everybody seems to have an opinion right now. I mean, right now, just for austerity's sake, S&P's fighting to hold on to 4,000. The Dow's right around 32,000. It's a very bad down day today. I expect some of these people that you have up there on the screen to be there. In fact, one of them's on there now on CNBC talking to us, telling us what to think, what to do. There's a lot of opinions, and these opinions can be very dangerous. Very few people are offering facts and data to support what you should be doing. And I've written several blogs recently talking about what you should be doing, and that's what we're going to be talking about today. But to just put it in perspective, this has been a very difficult year. I shared this chart a lot in my blog. In fact, I think every Monday I've been updating it to have just a few key data points. The number one thing being is right at the start of the year, the Federal Reserve warned that they needed to raise rates to fight inflation. Now, this was new news to some people. I'd been saying for over a year now that the Fed needed to raise interest rates, but finally the Fed is going to get serious about inflation. And I've added some key dates on there. They didn't raise rates, the market rallied, and then it sold off. And then they did raise rates and the market rallied, and then it sold off. And then Powell warned that they were going to have to raise by 0.5%. The market sold off and then rallied, and then they finally did raise rates here a couple of weeks ago by 0.5%. The market rallied that day, and since then it's sold off, and you can kind of see where we're sitting there today. Everybody knows that it's been tough. The real question is, what should we expect? So what I want to do today is zoom back out and take a look at the current market environment and how that might impact different investments and what you should be doing with your investment accounts, if anything. And that's the important thing to understand is there may not be anything you need to do, but maybe you just want to gain a better understanding of what's happening out there. The main thing I keep hearing people talk about is when we get back to normal. And a lot of people are talking about getting back to 2019. And everybody's so much focused on that they're not understanding that during any recession, we tend to see a structural shift in different parts of the economy. That's what recessions do, is they wipe out some of the things that shouldn't have still been around, that were absorbing capital that maybe shouldn't have. And then we see new businesses and new industries born out of that recession. And I know we've seen this during the last recession, during the pandemic, but people are still so laser focused on getting back to 2019 when I don't think we're going to get back to 2019. What you have to understand is the economy has absorbed and received half of its output via Federal Reserve quantitative easing, which is just now ending, which just blows my mind. And then we had spending bills in 2020 and 2021 that really juiced the economy. So we dumped, in the matter of 2 years, 50%, half of our economic output, into the economy. And now everybody's saying, well, I don't understand why prices are so high, or I don't understand why we can't get certain products, or I don't understand what's happening. And it's because this has never happened before in the history of our economy. We've never seen this high of a percentage of the economy just dumped into there for people to spend. And what we see happening is, I marked some critical things on there. This is consumer spending. You could see the Trump tax cuts. We did have a boost. And then it actually, before the pandemic, had started to come back to the more longer term trend line in spending. And then we had the big drop in spending and then the stimulus checks. But even after the last stimulus checks, people have just kept spending money like crazy. And you can see it's well above trend. Well, if you think about it, it's not just that we sent them money. It's that we locked people up for a year, 2 years in some parts of the country. We had vacations canceled. We had conferences canceled. We had everything where you just couldn't do it. And now that they can, they're spending it. And they don't care that they're dipping into their savings that they banked during the pandemic. They don't care that now Federal Reserve data is showing credit card usage is up 25% from a year ago. One of the best parts of the pandemic from a personal finance perspective is we saw credit card debt decline during each of the months of the pandemic. Well, now it's up 25%. So people are spending whether they have the money or not. The problem is, if you look at personal income, you could see the 3 rounds of stimulus. And this one here is what I really want to focus on, because this is what I wrote in the blog a year ago. And this is what I said during our webinars that we were doing last year is, this will cause inflation and this will cause a disconnect in the economy. And you could see why. Look at how much bigger this last stimulus check that most people started getting in April last year was compared to the other ones. Well, now if you look at personal income, we're threatening to have personal income, disposable personal income, being below where we were at before the pandemic started. And that's because people are working a little bit less. They're not having all that money coming in from the government. The child tax credits have gone away. They've changed jobs. Maybe they opened a small business. But personal income overall in our country is almost below where it was at when the pandemic started. So that becomes a concern, because we can only go on that vacation that we missed once. It's not like we're going to take 3 vacations in 1 year. It's not like we're going to make up 2 years worth of not going to the movies, or 2 years of not being able to get massages or going to the nail salon or whatever it was that people were spending money on. That's starting to weigh on people. And I firmly believe, now again, this is opinion, not fact. I think the facts will bear it out, and we'll wait for those to come up in the economic data. But my opinion is, once we get through this surge of vacations going into the end of the summer, we're going to see a rapid drop in spending, because people are spending now, whether they have the money or not. They're not going to have the income to back it up come the fall. And we're going to see a big drop in spending and probably the economy. And one reason that makes me believe that is consumer sentiment is awful. There's only been 2 other times since the 1980s that sentiment has been this bad. The last time was 2011. Remember, that was when we had the Arab uprising and we had the threat of Greece and Italy going bankrupt. We had what I call the debt ceiling circus, which is when they were threatening to not extend the debt ceiling, and we saw government shutdowns. And in fact, S&P pulled the US's AAA credit rating during that time. People were pretty negative back then. We also saw very negative sentiment back in 2008. But the last time before that was all the way back in the 1980s. And of course, we had runaway inflation back then. We were going through some big social changes back in the 80s. And again, ignoring the impact of being locked up for 2 years, when people feel bad, they don't tend to spend a bunch of money. And sentiment is really bad right now. And one reason it's really bad, I believe, is inflation. And so if you take a look at this, I think it's very interesting when you pay attention to here is I have some different averages of inflation. And the first solid line is it's the PCE price index. And I didn't use CPI. I'm not going to get into the reasons I don't like CPI. It's a terrible measure of inflation, but it is something that a lot of people pay attention to. PCE is what's included in GDP. It's the Federal Reserve's preferred method of measuring inflation, and it's a little bit more accurate, they found, than CPI. But you could see this index is running above 6%. But if you look at the orange line, that's the 5-year average. We're just now barely getting back above 2%. If you look at the 10 and 20-year average, we were running below 2%. And why that's important is, for my entire working career, going back 25 years, the Federal Reserve has been targeting 3% inflation. The Federal Reserve has failed to get to 3% inflation until very recently, and now they've way overshot their target. And I won't go into their decision making. I've said in my blog many times, I think it was a mistake, and I don't know why we trust the Fed to control inflation, but the strongest and most powerful central bank in the world has tried for 25 years to get inflation to 3%, and they've only gotten it to 2%. And I know right now we are all paying a lot higher prices. It is getting very uncomfortable for a lot of people, and there's a lot of people who are having to make some very difficult decisions. So I don't say any of this without a lot of empathy for anybody dealing with it. But we have to understand why we had 2% inflation despite the Fed's attempts to get it up to 3% is because we have a lot of things working against higher prices for the long term. And I'm talking the next 2, 3, 4 years from today, as I believe we're going to see inflation, what they would call disinflation, which is a very low rate of inflation, possibly even below 2%, 3 to 4 or 5 years from now. And one reason being is deficits are very deflationary. If you're spending money today using borrowed money, that money has to be paid back. So that means you have less money to stimulate the economy in the future. So that's deflationary. Too many retirees are deflationary. There's something called a money multiplier. If you're working and you receive a paycheck and then you go out and spend that money, you're helping to keep somebody else employed, which gets a paycheck. So that money multiplies. Once you turn off that paycheck and you start receiving money back, which is borrowed money, because Social Security does not have money sitting in the bank, they have IOUs to the federal government that says, hey, you owe us money for Social Security. So we're borrowing money to pay retirees. That's deflationary because there's less money available to spend. Excess savings is deflationary. And that's something that we're going to really start to see, I believe, after vacation season is over, is people are going to go back to tightening their belts. That causes deflation because people are spending less money. Ironically, increased productivity is deflationary. And we've already seen a boost in productivity just during the pandemic. And I believe, from talking to businesses in different industries, we're going to continue to see that, which overall is actually deflationary. That helps to bring down inflation. And then we have inventory surpluses. We've seen, because of the supply chain shortages, people are putting in orders 2, 3, 4 times higher than their normal orders. We're going to see that supply and demand get out of balance again, where all of a sudden everybody has too much inventory on hand. The last time we really experienced that was back at the end of the 1990s, when everybody was dealing with Y2K. If you remember back then, we were talking about, you know, who knows what's going to happen? Who knows what's going to happen with the supply chain? Everybody needs new computers. So people bought way too much inventory, and then we had a deflationary recession over the next several years because of that. And then finally, it sounds dumb to say, but from an economic perspective, inflation is deflationary. And again, I'm not taking anybody's personal situation lightly. Inflation is hurting our economy, especially those in the middle class and below. It's painful what they're going through. And I'm not taking this lightly, but If inflation stays high too long, people start spending less, that becomes deflationary. So again, I don't want you to see 6-7% inflation and think, oh my gosh, this is what it's going to be like the rest of our lives. I will remind people, my first economics class in 1988, they told me normal rate of inflation was 7%. And they also told me the normal rate of unemployment was 7%. As you see from this chart, we actually were running around 2% over the last 20 years. So just because it's high now doesn't mean it's going to be high. From a fundamental perspective, we're likely to see disinflation as we move out over the next 3, 4, 5 years. Now, I don't want to get too much into politics, but I do need to remind people who are maybe feeling a little bit emotional, a little bit concerned about the future, is the independents control the vote. And we've seen since the election in 2020, we've actually seen the number of Democrats go down by a couple percent and the independents pick up 2 more percent. So the American voters are restless. The American voters are not happy. I don't believe we're going to see a far right mandate or a far left mandate. We're going to continue to see independents voting from the middle. And right now, what that looks like is we're probably going to see a big change in Congress. But that change is not going to mean we're going to get back to right-wing politics. It's going to be somewhere down the middle. And if the independents aren't happy in 2024, we could see it swing back the other way. So I only bring up politics to mention that the very loud far right and the very loud far left, they get on TV, they dominate social media. If you look at surveys, most Americans do not fall in the far left or the far right. They're somewhere in between, and they vote accordingly. Now, I want to look at a couple of charts that I think help put things in perspective, because on CNBC for the last 3 months, all I've heard is people saying, is this the bottom? And the reason they're asking is we've been programmed over the last 12 years that every time the market drops, we should buy the dip. And that's worked very well, because even in 2020, we saw a 35% drop and then it recovered it. And before the year was out, we were positive on the S&P 500. And now we're going through another dip and everybody's on TV saying, well, you got to buy this dip. And I always say, buy the dip works until it doesn't. Because what you see happening during a bull market is you have a bunch of excesses created. And then a bear market takes those excesses away. During a bull market, people will tell you, well, it's different this time, and they'll have a reason why we don't have to look at fundamentals, why we should just buy stocks, why we shouldn't own bonds, whatever the advice is on TV. This chart here shows you what happens. When those excesses are removed, it happens over a period, on average, 18 to 24 months, and it goes down 35 to 50%, because the market gets way ahead of the fundamentals. It gets way ahead of what the economy is capable of producing. The excesses are removed, and then we have a rally, and during that rally, everybody says, hey, it's different this time. And then we have the excesses removed, and then we have a big rally, and what I'm calling the everything bubble, because the Federal Reserve has thrown so much money into it, everything's in a bubble. Everybody tells us it's different this time. We may have already started that period where the excesses are being removed. Unfortunately, nobody has that exact indicator to ring the bell and says, this is the top. All we have is different economic and market-based indicators that we at SEM use to make those decisions. Now, one thing I continue to remind people of, even with a 15% drop in the S&P 500, stocks are still at very high valuations. And high valuations mean low future returns. And we've seen that throughout market history. This chart goes back into the 1870s. And every time we've gotten PEs that are above the long-term average, we've gone through a period of low returns. What's a little bit uncomfortable for a lot of people is most of us in our investing lifetimes have not seen bonds going down at the same time as stocks. So when bond yields go down, bond prices go up. And what we've seen, minus really 1994, is when stocks have gone down in value, bond yields have gone down, which means bond prices have gone up. But this chart of bond yields is showing that we may be finally breaking out of this downtrend in bonds, which means for most of your investing careers, you've had buy and hold bond portfolios going up when stocks go down, and that may not happen. It's not different this time from a market history perspective, but it is probably different than you're used to, especially in your 401k, TSP, Virginia retirement, whatever employer plans that you're in. You're used to bonds providing a buffer, and they haven't been providing a buffer so far, and they may not, depending on what happens with interest rates going forward. Another thing that I think is important to understand is because we have high bond and stock valuations, we may not hit the long-term averages over the next 10 years. In fact, the biggest names in the industry, BlackRock is saying your 60-40 portfolio used to average 8.3%. They're telling you to expect a 4.7% return annualized over the next 10 years. You look at Vanguard, they're even lower, 2.4% return for a 60-40 and only a 3% return for buy and hold stock investments. And Morningstar's even worse, they're saying 1.6% across the board. You have high stock valuations, you have high bond valuations. Typically that leads to problems with long-term returns over the next 10 years. Because you're buying high, that means your potential returns are much lower. Now, I'm not saying that's what SEM's returns are going to be, because we're not a buy and hold investment. But if you're in these types of portfolios in your employer plans, you need to lower your expectations until valuations come down to more reasonable levels. Then we can go back to looking at not only average returns of 10% for stocks and 5% for bonds, but much higher returns depending on how low valuations get. Now, I talk about this in every single presentation I do because I think it's important to understand this. The stock market's a story of cycles, and human behavior that is responsible for overreactions in both directions. And we've shown this chart. Courtney made it a lot more interesting by throwing some emojis on there. And this is the cycle that every individual person goes throughout the ups and downs of the market. And some people may have already beat the despondency based on the questions we had coming in before the webinar. There are some people down here, but if you look at the market overall, I feel like there's somewhere around denial, maybe moving towards fear, but we don't see that sense of desperation because everybody is on TV saying, I think the worst is over, you should buy this dip. We're hearing from people wanting to jump in and buy stocks in their employer plans. I don't feel like, from my experience, that we're quite to that point to say, everybody's despondent. This is our chance to have maximum opportunity and to buy low when everybody else is selling. And we're just not there yet. Now, from our perspective, what's important to understand is we have a long range of investments that are designed for different parts of the portfolio. And so what I wanted to do in the last 5 minutes or so before the formal presentation is over is kind of walk through our tools to handle this unprecedented environment and talk about some of the things we've done so far. Now, our best risk management tool is what we call our tactical models. These are managed every single day. They don't trade every day, but they watch the market every single day. And the most popular one, been ran in real time since 1992, is Tactical Bond. Income Allocator is actually even the lower risk version of that. And then Cornerstone-Bond as well has some of these same systems in there. The goal of Tactical Bond and Cornerstone-Bond is to be in high yields when they're going up and to get out of them when they're going down. And what I always remind people on that is we don't have an exact signal that says this is the end, get out, and now it's only going to go down. We invest on what's called the hard right edge. Is we take all the data and we say, based on market history, it's either likely to be favorable or not favorable for high yield bonds. And you can see there's a lot of times where we sold and had to get back in. That's the red is the sell, the green is the buy. Well, by the end of January, we'd gotten our last sell signal in high yield bonds. And so Tactical Bond and Cornerstone-Bond went to what normally is considered a low risk bond, which is a less than 1 year duration treasury bond fund. But even those lost a little bit of money on there. They're now all sitting completely in cash and money market accounts. A better way to look at it is, this is a high yield bond fund. And I've put in orange times where this system would have triggered. And you could see there's times where the bond went down a lot, and there's times where it barely went down and you had to jump back in. Well, this is where we're at right now. You could see when that sell signal came at the end of January, it's gone almost straight down. We don't know when that's going to end, but here's the exciting thing. The more it goes down, the more opportunity we have to make money once it finally starts to bottom out. So that's the tactical systems. They've done a phenomenal job. They did what they were supposed to do. Almost all of their losses came at the beginning of the year, the first 5 or 6 weeks. And the rest of the losses have come in very small chunks in what should be considered low risk bonds. And now they're sitting in cash. So they're very well positioned right now. Moving on to our dynamic models. These are models that are managed monthly, and they use our economic system. And I'm not going to go through each of these. This is actually a chart that I do with the Financial Planning Association to kind of walk through our economic model and some of the ways it adjusts. What's more important for you to understand in this environment is this economic model either gives you a green light, yellow light, or red light. We were on a green light. That's when this line's all the way up here, all the way up until October of last year. And then it said, whoa, I think the economy is starting to slow down. So it went to a yellow light. And then in April, it dropped to a red light. Now, it's not saying recession, but it is saying we're seeing a slowdown. And that's one of the things that's hitting stocks right now is there's a very strong chance that we go into a recession. And if you were paying really high valuations for stocks, expecting strong growth rates, and the economy slows down, you need to reduce the valuation of those stocks. And that's what's happening in the market right now. And that's what this model is designed to do. Now, I'm not going to go into each transition that this model is making. This is for dynamic income. What's important to understand is when we're in a weak economic environment, dynamic income has no stock exposure. It's in tactically managed fixed income, similar to what you saw with tactical bond. Most of those are sitting in cash or lower risk bond investments now, waiting for better opportunities. And then we have a model for treasury bonds. Dynamic income is actually up a little bit over the last month because it has invested in an inverse treasury bond fund. So when interest rates go up, this fund actually makes money, even though the prices are going down. Now, it doesn't mean we're going to stay that way throughout a recession, but that's where we're at right now. On the growth side, on the dynamic side, is now that we're in bearish mode, we've gotten rid of all our small caps and emerging markets, and we also have a little bit exposure to bonds, although it's not treasury bonds in there, but we've reduced almost all small cap holdings. And in fact, I was looking last night, small cap stocks are now all the way back to where they were at in April 2020. So the small cap index in just this past, 8-9 weeks has given back all of the gains that we saw following the end of the bear market in 2020, which is just fascinating to me. So finally, I'm not going to spend a lot of time on our strategic models because those are designed to be longer term. They have made adjustments. They are based on data. And they will invest in different things: momentum, large versus small, value and growth volatility, and then US versus international. I'll just say at the beginning of the year, they reduced growth exposure. In April, they reduced growth exposure even more. And we have no international exposure. So we're mostly large cap, a little bit of mid cap. They're doing their job, but they're long-term investments. So they're not going to make big moves based on what's happening. We also have biblically responsible models that are doing the same thing with an added screen as far as doing things that Christians find important there with their investments. What is important is even in Ameriguard and Cornerstone is there is a little bit of money that will come off the table. And we've seen that with March 4th and February 22nd, we've seen some money come off the table. So for instance, in Ameriguard and Cornerstone Growth, they're, instead of being 100% invested in stocks, they're down to 70% invested in stocks. That's as low as they go, though, because they are long-term investments. I think that's really important for you to understand is those are designed to be your long-term investment money. So they're going to stay invested much longer. They're just going to be invested in different things than the typical buy and hold portfolio. Now, This was one of the questions that we had, and I will share these slides on our webinar page, just so you have them, because I'm often asked, well, how do you deal with inflation? And we have a lot of mechanisms in place to deal with it, but it depends on the impact of inflation. Because you could have inflation with strong economic growth, you could have inflation with average economic growth, or you could have inflation with declining economic growth, which is called stagflation. You may have heard that, or you may remember that from the 1970s. So we have a plan in place. That's all you need to understand, is we don't have to guess. We don't have to listen to the people on CNBC or on social media saying, this is what you should do because of what's happening in the market. We have a plan. Now, what the market is looking at right now, and this is what our economic model is saying, is we're shifting from an average growth to declining growth. And that's important to understand, is that stocks are going to struggle. We've already made adjustments to that. Bonds are probably going to struggle, and high yield and corporate bonds actually may be a little bit better than treasury bonds. That doesn't mean for sure we're going to stay in this for 3 to 6 months. We could be here 3 to 6 weeks. Our models are designed to look at that and not make those guesses. Now, finally, I just want to look again at our models. If you look at what we've been doing as far as the most activity, we use a bucket system. Bucket 1 is to take care of your very short-term needs. We have income allocator in that bucket. It's low risk. It's designed to keep your losses under 5%, but cash is included in there, other short-term things. Bucket 2 is also for short-term money. And then bucket 3, 6 to 15 years. We've made adjustments in all of these portfolios, and they are doing phenomenally well versus a buy and hold. The risks out here, bucket 4 and bucket 5, we've made some tweaks, but they're designed to be your long-term money. Notice 15 to 25-year time horizons for buckets 4 and bucket 5. So all of our investments here, they're designed to ride the market up and down a little bit. What becomes more important is our behavioral pyramid is designed to base everything on your complete financial plan. You need to define your specific goals and objectives for each bucket of your money, work a cash flow strategy, and then the investment area comes in. How we manage the portfolios is solely based on your financial plan and your cash flow strategy. So if you're not sure, ask your advisor. We have a lot of tools to give you a quick and easy, we call it financial roadmap. It's there. If you're working with a non-SEM financial advisor and you don't have a plan, you need to contact us. We will help you develop a plan, because the question on what you do with your investments depends on what your financial plan says. For most people, the losses they've seen in their portfolios thus far make zero difference in their financial plan, because we had that already worked into their plan. If you don't have a plan, you have no idea what you need to do with your investments. So everything you do is based on that financial plan. So with that, I'm 3 minutes over the formal part of the presentation. I will remind everybody there's a Q&A button there at the top or bottom of your page, depending on what browser and whatnot that you're using. I will, if you are going to hop off the call, remind you semwealth.com is there for you. There's a lot of different things. You can see under the more button, the risk questionnaire. If you're a client of ours and you just want a quick checkup of your portfolio, click on that. Somebody at SEM on the portfolio management team will review it and then pass that along to your advisor. If you are a client and you need to access your account through Axos, it's there for you to look at. And then on the home page, if you scroll down a little bit, you can see the trader's blog. Every Monday morning, at a minimum, I'm posting a page on there to talk about what's happening in the markets. I call it the Monday Morning Musings. If necessary, we will post more frequently, but that's kind of your source to see and hear what's happening on the trading desk. So if you take away one thing, it's everybody's opinion doesn't matter. What matters is the data. SEM has a data-driven approach that's, we're 30 years and counting since we've been around. I've been here for 25 of those years. There's no panic in our office. This has been an awful, awful year, and I I hate that people are losing money. There's no panic. There's no guessing. We're doing our job. The portfolios are doing their job. If you're in a situation where you're uncomfortable, whether you are an SEM client or not, take our risk questionnaire. We need to talk about your time horizon. Is this money you need in 3 years or this money you need in 30 years? There's a big difference on what you should do based on that. Are you going to live off of your investments in retirement, or do you have a pension and you don't even need your investments during retirement? That's a completely different conversation. So thank you to everybody, clients, advisors, people just checking us out. I truly appreciate all your time. I appreciate you tuning in. Stay tuned, follow us on Facebook, YouTube, follow the blog. We're gonna have updates. If things get crazy throughout the summer, we'll be here as often as possible. Even if they calm down, we'll be back here in a few months with another update. So thank you, everybody, and just stay safe.